Welcome back to the Beat the Odds, a Business and Wealth podcast. Trevor, I think we're going to have a pretty good episode here today. We got 0% capital gains tax incoming, so they tell us, right? That's the 0% capital gains tax income.
Wow, that sounds incredible. 0% capital gains tax. I'm down for that. Likelihood of that happening? I don't know.
We are Dubai North, right? Like sudden change, sudden shift. So let's drill through it because often the devil's in the details, but that's what we've been told is the 0% capital gains tax, right?
All right, 0%. I'm down with that. Let's get into it.
Okay, first of all, we got a lot of movement here today. Like we have a lot of the craziness in the markets. I saw oil dip down to $60 a barrel earlier this morning, right? Back up to 62 right now, but I saw $60 a barrel earlier this morning. I see the S&P 500 now, now we're 5,200. We're kind of like 15% off the highs. You can see the bond market in the U.S. We're up to 93. The U.S. 10-year yield now dropping below 4%. So dropping below 4%.
Wow.
So,
okay.
We're looking at the U.S. dollar 145 against the Japanese yen. The Japanese stock market, that's I monitor this because I still think it's the canary in the coal mine. So I think if it's a crisis waiting to happen.
Yeah. What's our debt to GDP?
Oh, it's well over 200, right?
Holy
So it's
cow.
well over 200. Canadian dollar, back up over 70. Back up over 70. Not that our dollar is any better. It's just the U.S. dollar got worse in the last little bit. So. TSX, here we go. I'm getting excited, Trevor.
Okay.
I am getting excited. It's at 23, so we're off of our highs of 25.8, and we're down to 23.5, and I'm looking for 20,600.
20,600. And why 20,600?
20,600. That would be an actual bear market. So that would be a 20% decline. We're not off as much as the U.S. market in percentage terms yet, and so like a 10% decline, that's a correction. That happens all the time because someone tweets the wrong thing, or someone wears the wrong color socks, or someone says something not nice to someone on the parliament floor. The wrong article comes out, or who cares? Like it's 10%. That's just the nature of owning stocks. Like people get so zoomed in on that. That doesn't matter. But 20%. That's a real number. That's something you only get that opportunity, every 5 or 10 years, and usually you don't get to see it coming. But we've been telling everybody it's like the probability of that happening is like it could be high. So that's the cash on the sidelines, and it's the counterintuitive. People are like, well, if you own stocks, don't you want it to go up? It's like no, I want it to be super volatile. I want the CBC to put everybody into a fit of rage and take their money and stuff it in a mattress, and the money and it to go down, and to get them infected with the Trump derangement syndrome, and everyone's just panicking and taking money out, and it's like. Because the little guys take the money out and the big guys say, come to daddy. Come to daddy. I'm going to buy this stuff. You know what I mean? Like, I'm not worried that I'm not worried that the oil that coming out of CNRL is going to be worth less. I'm not worried that people are going to cancel their telephones. I'm not worried that the Royal Bank's going to go out of business. Yeah. It's like, I'm just going to buy stuff on sale. So you don't get a lot of opportunities. They don't come around every year, right?
No,
real opportunities. People are.
Yeah, like the last few that this has happened, 2008, 2000, like these big swings that have happened in the market. I wasn't prepared for those, but now at this one, I'm kind of prepared.
Ready to roll.
Ready to roll. Let's rock and roll.
Ready to roll.
Let's take advantage of this. I mean, you can see a lot of gains over a short period of time once that market hits that basement level, right?
Yeah. Rosemary Barton, please scare the bejeebers out of everybody, because our clients are going to swoop in there and we're going to buy a whole pile, right? And
what does the Oracle of Omaha say? He says, what? Be greedy when others are fearful, and be fearful when others are greedy.
That's right. Right. And so it's coming. There's a real opportunity coming. Gold prices, right? had one of my American friends the other day asking me, hey, what comes first, second, and third. It was, Canada becoming the 51st state, or gold at 4,000 US, or the arrival of the Antichrist. And those were the three things that he was asking if in what order they were going to come. And I said, well, I think gold will hit gold will hit 4,000 US long before Canada becomes the 51st state.
Yeah.
And, the one world government obviously precedes the Antichrist. And that was my technical analysis of that subject. So, or whatever it's worth, but that was it. Bitcoin not doing too bad in the market sell-off in the context of things in the last couple days, with the market down so much. And Bitcoin is like, the narrative changes. Like, people view Bitcoin as a risk-on asset. But in reality, Bitcoin is the risk-off asset. It is the risk-off asset. But that's going to take time for people to understand that the Bitcoin network is 1/21 millionth. If you want a Bitcoin, it's 1/21 millionth of all the wealth on planet Earth, and that's how that's going to arrive and likely play out. But for now, people still view it as a risk-on asset. But you can kind of see these little deviations, like the last couple of days, where here we are, right? And you're just kind of looking year to date. It's like, zoom out a little bit. People get really too far zoomed in a tight monetary regime. Like, for the last year, it's been a relatively tight monetary regime, and we're fine. Like, in the last year, we're still up 27% on our Bitcoin positions. And, comparing that to the S&P 500 in the last year, you're basically flat. You're basically flat, right? Yeah. So that's where we are. So it's funny, because sometimes you'll talk to people, it's like, oh, Bitcoin's gone down from 150. It's like, I started buying at 40, and I rode it all the way down to 20, and I kept buying more. It's like, you think of it, if it goes down from 150 Canadian to 80 Canadian, it's not even going to phase me, right? So,
and you look at MicroStrategies, and they just bought a schwack more. They just bought a whole bunch more Bitcoin. Why? Because it's on sale. I think Michael Saylor said, if you believe that Bitcoin is going to 1 million, 80,000 or 100,000 is kind of irrelevant at this point. It doesn't matter.
You're trying to time it. Like, that's the danger. Like, the danger is you're out when it melts faces, right? Like, most of the gains they're relegated to a few days every year, and if you're not in the market, like, you just miss out. So, leave timing it to the guys who have enough capital to move the market the way they want, right? But the little guy trying to timing it, you're lying to yourself that this thing just moves in an unmanipulated fashion, right? So, okay. So let's get to Poilievre's announcement. With that context, is Poilievre announces the Canada First reinvestment tax cut. Okay. Today, Conservative leader Pierre Poilievre announced the Canada First reinvestment tax cut. Any person or business selling an asset will pay no capital gains tax when they reinvest the proceeds in Canada. Companies that reinvest in active Canadian businesses will also defer any capital gains tax. These gains will still be taxed later on when investors cash out or move money out of Canada. The break will be available on any reinvestments done until the end of 2026. Okay, so
that kind of sucks.
First of all, when they say it's 0% capital gains tax, it's not 0% capital gains tax. So let's break it down for the average person. It's like, where does the average person have most of their investments, if any? They're in their RRSP or TFSA.
That's right.
So is this change affect that at all? Zero. It has zero impact for anybody in their RRSP or TFSA. This is not going to make an ounce of difference, because you could transition out of U.S. assets into Canadian assets anytime you want, and there's really not going to be any impact of that whatsoever. So that's not what it's for. It's for, like, primarily it's going to be for unregistered investments, and primarily, like, what do most Canadians have of unregistered investments, if they have any, is they probably have U.S. stocks. Probably have U.S. stocks. Maybe they have some foreign real estate. Maybe, right?
Maybe like S&P 500, blue chip stocks, that kind of stuff, right?
Small percentage of the population, right? And I can see, like, the temperature, because, sometimes I posted it online before what the average holdings are in people's RRSP, TFSA, and unregistered. And people read what the average holding is in unregistered, and immediately they just say, this information is not correct. No one has that money in their unregistered. It's like, no, you don't have that. You and the people you hang out with don't have that in the unregistered. But what happens is there's, for every 100 people who has $0 in their unregistered account, there's another guy who's got 10 million. And that totally skews the averages of how this thing works. Because
do you think Mark Carney has an RSP saving up for his retirement tax deferred?
I guarantee you Mark Carney's got some unregistered investments. I guarantee you he's got unregistered investments, right? I'm sure they're in a blind trust, right? No, totally no.
I have no idea what's going on with that money.
Yeah, so like, it's not going to affect anything in an RSP or TFSA, and people have to realize that's only going to affect people who actually have unregistered investments, and it's not a 0% tax. So all it is like, it's not going to allow you to crystallize a 0% gain. It's just going to allow you to roll over the investment at the current cost base. So when you eventually sell that investment, if you bought something for $100,000 and went up to $200,000, and say your S&P 500 index fund is now at $200,000, and you cash out at $200,000 and you buy an index fund of Canadian stocks, and that goes up to $300,000 someday, your cost base is still going to be the 100. So you're not avoiding the capital gains. You're just deferring it. You're just going to be able to roll it forward. That's the reasonable interpretation of what we're seeing there. And even when I say that, it's not super clear to me. Like, it says active businesses. So, I mean, when I read active businesses, I would assume that is, Canadian stocks, public Canadian companies. What I saw a whole bunch online was a bunch of realtors getting this and just saying, like, we're going to get 1031 exchanges in Canada. I was like, no, that's not what it said at all. Like, that wasn't even close to the announcement. No one's saying that we could roll over Canadian real estate into bigger and better rental properties. Like that there was nothing of that at all. It was, you could roll over foreign assets into Canadian assets. So I suppose if you had some foreign real estate, you could roll it into Canadian real estate. But that's, most people, like a very small percentage, have any unregistered foreign assets outside your TFSAs, and a very even smaller percentage that the most common foreign asset that people are going to have are U.S. stocks, not even foreign real estate. So, so people have to understand the context of that. And here's where the shift is necessary, is most people think that, the only way to manage your life tax efficiently is for RRSPs and TFSAs. And that's just simply not the case. Like, your RRSP is, I always tell people it's a scam because it's sold as a fast way to grow your money. It's not, it's just a tax deferral tool. And for any sort of intergenerational wealth, it's useless. It's completely useless for any intergenerational transfer. So if your goal is intergenerational wealth and your vehicle is RRSP, it's like, having a Ford F-150 and trying to go to the moon. Like, it's just not going to work for that. For that, it's like you're taking half when the remaining spouse passes away, right? And people get into all the exclusions on, like, oh, you can transfer to the kids if you die before they're 18, and then the child has to bring it into income by their 18th birthday. So, like, it's not an intergenerational transfer. Like, it's just not. Like, hopefully you outlive your kid's 18th birthday, number one. And,
repeat after me. RRSPs are a scam.
Yeah. So, okay. So, and there are ways that people can use unregistered accounts. And so I see this as like, there's your tax-free gain. It's like, I wasn't planning on paying any capital gains tax anyways. The goal was always 0% capital gains tax because I bought the right thing. Okay. I bought the right thing. And so, what do I have? Like, I don't own any foreign real estate. I don't own any foreign real estate because it's a bit of a hassle to manage. Like, it's a hassle to manage. It's hard to manage. Okay. I personally, I don't have any U.S. stocks. I haven't bought any U.S. stocks because they're not conducive to my tax, capital gains free tax lifestyle that I've already assembled for myself. Okay. Like, I didn't plan on paying any tax. Okay. on capital gains. So, there's a certain segment of the Canadian stock market that performs very, very well that we teach people in the boot camp, and the dividends that they pay are very, very efficient, but people, just group it in with the underperforming TSX versus the S&P. It's more nuanced than that, people. It's more nuanced. If you just look at the S&P versus the TSX, you're going to want to choose the S&P. But if you start looking at what I like to call the government-protected monopolies that we have on the TSX, and you compare those to the S&P, you get a completely different answer. And then when you factor in the fact that if you organize it in the right way, you won't have to pay any tax, and you can leverage them really, really well to actually grow your money faster. So putting your money in an RSP is not a way you grow money faster. The way you grow your money faster is leverage. Leverage is how you grow your money faster, okay? And your RSP is not an effective vehicle for that, right? Like that's just not the effective vehicle for that. And quite frankly, a lot of U.S. stocks aren't, because in order to write off interest, I need a reasonable expectation that the income, not the capital appreciation, that the income is going to exceed the interest. That's the test that CRA wants to see. So if I buy shares in Berkshire Hathaway that don't pay a dividend, I'm not going to be able to write off that interest. So I can still borrow to invest, but I can't make that interest deductible, and that's kind of a problem there, right? And so, what would in my life, it's like what I consider is like, okay, what about my Bitcoin? What about my Bitcoin? Now, am I going to sell my Bitcoin to buy more Canadian stocks? I already have a good, healthy position at Canadian stocks, so I have this isn't going to be anything I'm going to use personally. Like, this is not going to be anything I'm going to use personally, because I'm not going to sell my Bitcoin just to defer tax to get into more Canadian stocks. Like, I'm just not going to do it, because the goal of the Bitcoin was to never sell the Bitcoin. Everyone's like, well, what's the exit strategy for Bitcoin? It's like, Bitcoin is the exit strategy. It's like, you're not trying to sell the Bitcoin to buy the Lambo. What you're trying to do, if you actually believe in Bitcoin, is you're buying the Bitcoin to borrow against the Bitcoin to buy boring Canadian dividend-paying stocks that pay out tax efficiently, and then that dividend yield is going to make the payments on the Lambo, and then I can do that every 5 or 10 years. That's the infinite money glitch that if you actually believe in Bitcoin, like that's what you're trying to do, right? That is the end game. But you know what you have to have for that, Trevor?
What do you have to have, Josh?
Patience. You gotta have some patience. It's like those memes where you have those two monkeys sitting around. It's like, and he's like, when Lambo, right? And the other guy is like, hodl, like just like it's not gonna happen tomorrow. Like that's a 10-year time horizon on that sort of outlook, right? Mm-hmm. So, but where this will be applicable is I have, a lot of people have, I think they have over allocated in the U.S. And you start looking at the U.S. and you start looking at the price to earnings, and, you're paying, north of 30 times price to earnings for U.S. shares, and I can show you a segment of the Canadian market that has outperformed the S&P 500 for not just a couple of years, but for decades, right? But they're locked into these positions, and it's hard, right? And so people with over allocations to the U.S., and sometimes I see it, and it's like completely nonsensical. Like, they have RSPs and TFSAs and unregistered investments, and they have an equal allocation to all of them. They probably even have some fixed income products. And, in that sort of scenario, it's like you want to hold all of your Canadian stocks in the unregistered bucket, and you would want to hold your U.S. stocks in the RRSP bucket, right? They just have it even misallocated, even if they don't want more or less Canadian stocks, even if I don't like that. I want to have some in these different markets. Like, okay, fine. But even if you do that, you should own the stocks in the right bucket that are the most tax efficient, right? And so this will be an opportunity for people who are in, too heavily allocated in U.S. stocks, either overall or just in their unregistered bucket, to rebalance in more tax-efficient Canadian stock strategies, okay? Now, will they take positions in, Canadian real estate? I don't know if that's going to be applicable. I don't know when I read this, that you're going to be able to put that in real estate. It looks like it has to be an active business. So you'd have to put it in a home building company. Okay. Should some people do that? Maybe. Like, I do think there are people who, they got a net worth of, let's call it 2 million and up, and they don't really own anything other than their principal residence and an investment portfolio. It's like, that's actually kind of risky, they're because you don't have a stake in an active business, you don't have any gold, you don't have any Bitcoin. Like sometimes, like, that's a real risk diversification strategy. The banks will tell you buy our underperforming bonds. It's like, you just need me to buy those bonds so you guys aren't bankrupt on your reserve positions. But like, I don't want to, to reduce risk, I don't want to buy underperforming assets. I want to buy uncorrelated assets. Okay. Yeah. And that might help me, but it's a hard position. Like, it's a hard position because a lot of people who are looking for that, they need a partner. They don't have the expertise to do that. And so maybe that is something some people should consider. They have to have the risk tolerance and probably have to have the right partner lined up, because they probably shouldn't go from being a dentist one day to being a property developer the next. We've seen a lot of people try that, and that's
it usually ends in failure, abysmal failure. Because they just don't have the skill set, the acumen, and really the financing for it, right? Financing is a big deal when you're getting into that type of a development or of that asset, right? Yeah,
it's harder than people think. It's not just money that can solve that. It's money and expertise and the team. I've literally worked with in the past. I worked with a lottery winner, and he tried to build too many houses all at once, and he had sufficient money, but it's like, I work with other builders building houses. It's like we've taken years, if not decades, to build the team, that can actually help us build those houses, right? And so you're just not going to have the infrastructure set up, even if you have the cash. It's a slow moving thing, but it's something people should consider. So that's going to be the real opportunity, is for people who have over allocated to the U.S., or they got some foreign real estate that's hard to manage, and maybe they can cash out of that and they can put it into either, public Canadian companies or a private Canadian company. And even if they're just misallocated, whereas they're not over allocated to the U.S., but they have the wrong allocation in the wrong bucket. They're holding U.S. stocks and Canadian stocks in their RRSP and in their unregistered investments. It would make more sense to be heavily weighted in the Canadian stocks and the unregistered, more heavily weighted in the U.S. stocks and the RRSP. That's going to be an opportunity to rebalance. So that's what it is. It's not 0% tax, just like there was never a 66% capital gains rate, just like that was a 66% inclusion rate for anything over 250K. Right. This is not 0% capital gains tax. No. Okay. It's just a deferral for very certain, a very certain type of gain that you can defer if you buy a very certain type of asset. There's no 1031 exchanges. Please, realtors and real estate influencer on X, stop saying that it is. It's not, okay? Not to say I'm saying either way, yes or no, we should do that, but that's not what this announcement was. Okay.
We got to pay attention to the fine print on any announcement that's made during an election.
Yeah.
Right?
The next one was the extra $5,000 in a TFSA, an extra $5,000 for investments in Canadian companies. Okay, logistically, how this is going to go through, I've just thought about logistically how this would go through. So you get your $7,000 every year. I don't think there's any way that they would be able to do this in the same TFSA. Okay, because you're going to run into problems where, okay, you can put $5,000 in, and then you buy $5,000 worth of Canadian stocks, and then those stocks pay some dividends. So what about those dividends? Can I put that back into U.S. stocks? It's like it would be, if they try to do it in the same TFSA, it's going to be a reporting nightmare. So I would see that this would have to be a separate account. You would have your TFSA non-regulated, and then you would have your TFSA Canadian only, similar to how you have your you could have an RRSP and a spousal RRSP. It's going to have to live in a different account, or the reporting is just going to be a nightmare. I mean, who knows? Maybe they'll try it, but I could tell you the reporting is going to be a disaster if they try it. So I would see if this happens, it's going to have to be a separate TFSA, and that's not unprecedented, right? Like there's various types of RRSPs that are different. Okay. So you can have a locked-in RRSP and a not locked-in RRSP and a spousal RRSP. It's like a separate account. That's how that's going to work, right? But again, what percentage of Canadians are maxing out their TFSA? Like,
well, let's talk about this for a second. Like how many, we had job numbers come in this morning, which we'll probably talk about next week. That's not so good.
36,000.
1 in 7 are visiting food banks in Canada. Like we've had like the lowest in the OECD as far as economic development goes. We're almost dead last. So people who have an extra 5,000 to put into their TFSA is low. Yeah. Very low.
Yep. But this would be a real opportunity, because people have to realize that the urgency to get assets, like the urgency to get desirable assets, is good because the currency is being obliterated in front of our very eyes. And so, the relying on your wages, relying on cash as savings, relying on bonds as savings, like the urgency is difficult, right? The middle class is shrinking. That is how the monetary system is set up. It's set up with the creation of M2 money, creation of money. It is set up to move the wealth from the people who do the work to the people who know how to borrow smartly to invest. That is how this is set up. So, would the average Canadian use? They might use it, especially like someone starting out, like a younger person. Maybe they're still living at home and they're gonna bank everything. Like, oh, that's so good if they can do that. You know what I mean? They can bank that $12,000, right? And they're actually buying good quality, stocks or gold ETFs or Bitcoin ETFs in this TFSA, like that's going to be an avenue. Some people use it. Most aren't disciplined. Mm-hmm. Most aren't disciplined enough to use it, right? There's far more Canadians with a vehicle that costs $50,000 or more. Most people's vehicle is worth more than their TFSA. I'll just go right there. Yeah. Most people's vehicle is worth more than their TFSA, which is totally jacked up in every sense of the word. Like, your liquid investments should be worth more than your car. And anyone who says, "Oh, I need my car," like, no one needs $100,000 car. No one needs $100,000 car. It is a want. It is a want. It is an emotional decision. It is the difference between it's the difference between the Fossil watch and the Seiko watch and the Rolex watch. It's like it's a need, like it's a want, not a need. And all of them were emotional purchases because all of them were purchased by someone who has a phone that tells them the time. So they didn't need any of it, right? For most people, anything over a bus pass was a want, not a need. It's like, they're going to justify that I'm wrong, but it is the truth. Now, that's not to say that you shouldn't live your life and live well and spend the things that bring you joy, but like, you need to acquire assets, because your ability to earn your way out of it is going to get dwarfed with the monetary system. And that's the same whether you're at a minimum wage employee or you're a median wage employee or you're a top 1% earner. Your wages go down in relation to the desirable assets that you want to buy, right? That's the same for someone who works in McDonald's. It's the same for someone who's a doctor. And I say that and people, like, they get mad. It's like, the doctors, no, like, objectively, when you look at it, you require more years of a doctor's earnings to buy a house than you did 20 years ago. That's just the way it is. Like, is it even worse for the person at minimum? Yes, but objectively, all wages are going down in relation to the desirable assets that you want to buy. And so that is both a very unfortunate and scary thing. It's also a massive opportunity that if we know the direction of this thing, if we know the direction of increasing the money supply, every little bit that you can acquire of desirable assets will mean that much more, right? Will mean that much more. And, that's, what we teach people in the boot camp is actually how to, what are those tax saving strategies that you can actually, pay a little bit less tax, how you can get that money into desirable asset classes, and how the average person can access some leverage. If you're not Mark Carney, and if you're not on the board of directors for a public company, how can the average person get a little bit of good leverage that they can, they can level up quicker? And, that's what we teach everyone at the boot camp. We're coming up on May 10th. The tickets are over 90% sold. So, we'll have a full house again from people all over Canada. And I think this one's going to be, fun because it's going to be right after the election.
Yeah, it's going to be very interesting.
It's going to happen again. Yeah.
One thing to be clear is let's not pay attention to the news, what's going on CBC, but pay attention to the stocks and what's happening there. Like there's opportunities that are going to be coming up. And if you watch the news and you listen to the talking heads on the CBC, they're not going to give you the right advice. They're just going to make you afraid and fearful so that you hold on to every dollar and don't spend a thing. And, you stop buying things. You stop, doing those renovation projects. You stop, using your money to
Yes.
make your life better,
Yes.
which I'm seeing all right now. I think, a lot of people are just putting their life on pause, waiting to see what happens, waiting for the television to tell them what to do.
Yes.
Don't listen to the television.
Yeah. It's like the television was, telling me to cancel my Disney vacation. But, I didn't listen to the television last time they told me to travel. So I'm not going to listen this time over tariffs. Like, come on. Like, that's not going to happen here. Pretty much, it's like, I think George Costanza's that time on Seinfeld where he just started doing the opposite of anything that he thought was a good choice, and then his life improved, right? It's like pretty much if you start doing the opposite of what they tell you to do on CBC, maybe you might actually have in a comical way, you might have a better outcome. I'd like you to have a little more sophistication than that. I'd like you to come to the boot camp and actually put some reasoning behind that. But sometimes I feel maybe it would be better doing the opposite. Like it might actually work out better. But that is the goal. It's fear, right? The goal is fear, and I can't sugarcoat this. Like, most people are going to get run over by this, and I can't fix that. You can't fix that. The viewers, like, you can't fix that. You can't, rage on Facebook, and like we're not voting our way out of this monetary system. Trump can't fix it. Kamala couldn't fix it. Poilievre can't fix it. Carney can't fix it. You could vote for Bernier. He can't fix it. Like, this thing is coming. A massive expansion of the money supply is going to occur. It's right here. It's right here. This chart should be terrifying. This is our money system in a nutshell. This is gold, okay? This is gold since 1971, the beginning of this experiment. This is an experiment. We teach everyone at the boot camp on it. It's like we had 5,000 years of money that was backed by gold. 3,000 years before a government even figured out to put their head on a gold coin, and then 2,000 years of government money backed by gold, followed by 54 years of a fiat currency experiment. And here's where we are, people. We staved off elimination the first time in the financial crisis. We staved it off here, but we're right here. We're right here. That's where we are. And, it ends in more money printing. It ends in more money printing. Like, the rate of acceleration on the increases in desirable assets is going up. Most people are going to get absolutely run over by it, right?
Yeah. What was that terrifying stat you shared with me just yesterday?
Oh, man.
Because you did an inquiry on, I think it was either Chat or Grok.
I did. I asked Grok to do a deep think on at the current trajectory, when would the U.S. Interest expense exceed the entirety of tax revenue? And so if I pull it up here, it's like now it's one inquiry from one AI, and take it with a grain of salt. But here we are. It's $1 trillion. Okay, The interest expense is $1 trillion. And we said this on previous podcasts before. It's like, what does Trump get out of chaos? Trump gets out of chaos. He's trying to reduce the interest rates. Okay. What Trump gets out of chaos is now we're seeing the 10-year yield drop down below 4%. Okay. They can't afford to roll 36 trillion. I believe 15 trillion of this matures in the next year. They can't afford to roll that over at 4 or 5%. That's all of a sudden your interest on debt that you're going to be at 1.6 or 1.8 even before you start adding new debt, right? They want to roll the 36 trillion over at 2%. That's a better outcome, right? But in the long term, the problem is the economy is only growing. A $30 trillion economy maybe optimistically grows by $1 trillion a year. Meanwhile, your debt's growing at $2 trillion a year. And so ultimately, I asked Rock to model out where this interest expense would exceed the entire revenue. So forget about anything else, but basically the U.S. federal tax revenue of $5 trillion. And Rock said under the worst case scenario, could happen by 2030. Under the best case scenario, 2045. And under the likely scenario, 2035. That was the AI's result on the deep think on when does that interest expense exceed the entirety of revenue. And I think if there's ever, people always ask, they always say gradually and then all at once. If there's an all at once moment, it probably would be if there's an inflection point where it's all at once, it's probably that, right? We already know that the world is disposing of U.S. debt and buying gold. We know that. The gold price does not move like this because me or Trevor or our clients buy an ounce of gold every month. That doesn't move it.
That's people buying a lot of gold.
This is other central banks buying tons of gold, selling their U.S. treasuries and buying tons of gold because there's really only two big liquid reserve assets. There's only two big liquid reserve assets on planet Earth where you can sell 100 billion in a day if you got to prop up your currency. And it's pretty much U.S. treasuries and gold, and that's it, right? Those are the two playbooks. So if you can't hold U.S. treasuries, you're going to hold gold. And why do you want to hold U.S. treasuries? Because if you're Saudi Arabia and you're drilling oil, if you drill oil and you sell the oil and you buy U.S. treasuries, if you come back in 10 years, it's not looking very likely that you're going to be able to buy the same amount of oil back. So what are they going to do? They're going to buy gold instead. So we're seeing it on scale there, but we already know the world is disposing of U.S. treasuries and buying gold. They can't do it all at once, even if they don't believe it, even if they don't believe in the U.S. treasuries at all, and even if they're incredibly petrified on it, they can't sell them all at once because they'd crash the price of their own reserve assets. So they have to slowly over time sell off those U.S. treasuries. Meanwhile, Sally down at the RBC will still tell you to buy bonds because they're a good deal. But the smartest minds around the world are getting rid of bonds and they're buying gold, and they have been very consistently for quite some time now, right? Pretty much a decade at this point. So, and now it's starting to accelerate. That this should be the terrifying chart. This is not, gold's up. I hear people, gold's up. Gold's not up. The dollar you're using to buy it is down, and it's down a lot, right? 1 ounce of gold is still 1 ounce of gold. It's been that way for 5,000 years. It's still the same thing. It's the dollar's down, and that's where we are. And so, because I think there's a quote from both Thomas Sowell and Ray Dalio, and they both kind of in a roundabout way. It's when is what's insolvency from a government point of view? It's probably when the interest expense exceeds the entirety of the revenue. Just the interest. Forget about defense and Social Security and healthcare. It's just interest is more than the entirety of tax revenue. That's if there was an all at once moment. And would that be the all at once? I don't know, because it also depends on what the other countries are. But if there's the scary moment, it's man, nothing good happens in that moment. Will there be change? Definite change. Which change? Anyone who tells you with any certainty will be lying to you, but there'll be big change. Is that the central bank digital currency? Is that a complete transition to Bitcoin? Is that a complete transition back to a gold standard? Is that a shift in reserve currency from the U.S. to the BRICS countries, or is that war? is that a bunch of broke Americans who don't make anything, sitting on a whole bunch of military equipment, and they don't have the stuff that they want, but they got a whole bunch of tanks and planes and bombs? Like that can go poorly really quickly, right? And so we hope we don't see that, right? We hope that monetary policy leads to more money creation. In fact, but the unfortunate part of that is it makes the people with the assets that much richer. But that's probably the only way out of that scenario, right? So that's kind of what we have, and we hope we'll see as many of you possible there at the boot camp to give you the path out, because we don't have enough room on the life raft for everybody. We already know that we don't have enough room on the life raft for everybody, but it's actually a major opportunity if you understand the system, because you know what's coming.
Yeah,
we know what's coming, and we know the proven methods where at least you can put you and your family in a better position with the craziness.
Yeah, the Titanic is headed towards the iceberg, and it's going to hit.
And we got a raft making course that's going to happen. That's pretty much it. Yeah.
That's it. Yeah. All right, guys. Thanks so much for joining us today. We'll see you next time.